Hey, what's going on, everyone? It's Leo. So, today we're going to be talking about the SEC meeting from yesterday, and then we're going to dive into a little bit of technical analysis towards the end. Um, Before we get started, if you aren't subscribed, please do hit that subscribe button. It really helps out with the channel to grow and grow our little community here. So, without further ado, essentially the SEC decided to postpone the implementation of T+1 settlement. So what that means is transaction, right? So if somebody makes a purchase of a stock, that's the transaction plus one for the settlement date, meaning next day it has to be settled. Now, that I've had some time to think about this, I think it actually makes a lot of sense what they've done. Because, well, in order to really understand, I have to pull up where is it? How the synthetics are created here. So we've gone over this in the past. So if you see my previous videos, you should be familiar with this. But essentially, retail buyer wants to buy a stock, goes to their broker, right? Submits the order. That order flow is then sold to the market maker, right? Who then naked short sells a stock to the retail buyer. He sold them a stock he doesn't own. The market maker did. So now what happens? Well, T plus 2 days later, a failure to deliver is created. The market maker then can go to the DTC stock borrow program to borrow a share to give to the retail buyer, right? So that's how a synthetic is created, because in the DTC stock borrow program, that's essentially they're dipping into stocks that other people own, because all the stocks are held in the DTC vault. And so they dip in there, they take one of those, they give it over to the retail buyer. But now you have two owners of that share, right? You have the original owner that's over in, say, I don't know, Fidelity, and they have no idea that this has happened to one of their shares. And so you have two owners. And the market maker has no obligation to buy that back other than having to pay interest on the share that he borrowed. So what's interesting about this and how it relates to T+1 settlement is what happens if we break that cycle. If we come in here, because my understanding is the market maker, he has to wait T+2. He has to wait for an FTD to be generated in order to go to the stock borrow program. So what happens if we cut this part of it out? Because there is no more T+2 or T+3. Next day it has to be settled. So this is my speculation, but I think they are giving a 2-year implementation window for this rule, because I suspect this is going on with a lot of stocks. I don't think that it's necessarily just AMC and GME. There's a lot of others. Now, what creating synthetic shares does is it dilutes the market cap, thus reducing the price. So let's say that the market cap, let's say you have a company, the market cap of it is $100, right? You have one share. Now let's say that, okay, well, I want to make another share because I want my friend Bob to be a partner. So then you cut your share in half. So now there's two shares, right? Each one worth $50 now, right? So the reason that synthetic share creation destroys price of stocks is because it dilutes the value, right? Every time you print a new share in a company, that value of that company has to be split amongst that new share, right? Because you're diluting down the market cap. So that's one way that it destroys price. The other one is that it prevents price discovery, because the way markets should work is that you go in as a buyer, you want to buy a stock. If there's no stock available, or if there's nobody willing to sell you a share at a given price, then you have to bid higher, and thus forcing the price higher. The market maker, the way this works is he can just come in. If you say that, yeah, I want to buy a share at, say, $15, well, he has essentially an infinite amount of shares that he can just sell you at $15. So there's no price discovery. The SEC has already said that because of dark pools and everything that's going on, it prevents price discovery in the market. So if we do away with this immediately, what happens to all of those companies that this is being done to? If you immediately just kill the way that they're able to manipulate the stock market. They'd all skyrocket. It'd be devastating to the economy if all of them were to pop off at once. So what I think is happening, I think behind closed doors, with also considering the transparency rule, so everything's going to be exposed, I suspect that the SEC has tapped a lot of these funds on the shoulder and said, we're implementing these rules. You need to clean up your books now, because when this goes into effect, you're screwed. So I think that has something to do with why the price has been rising. I think that they're beginning to buy back their shares. And I think they're doing it. There's been talk, I think it was Lou who originally brought this up, that there's going to be a managed event. This is going to be managed the way they squeeze this. And I think that what that's going to look like is more gradual buying rather than market liquidations, them coming in and saying you're liquidated. Because think about it, who has to liquidate a hedge fund, for example? If they're overly short, it's going to be the prime brokers, right? Who are the prime brokers? TD Ameritrade, big funds like that. Now, if we're right and they are as overly exposed as we think they are, what happens if a hedge fund goes bankrupt? Well, it falls onto the prime brokers to foot the bill. So if you have this mutually assured destruction between brokers and the hedge funds, why would they margin call you? Why would I sign my own death certificate? Yes, I know they're way over leveraged and this got out of hand, but why would I sign my own death certificate? It doesn't make sense. That is what would cause it to the price to just skyrocket. So I suspect that Lou is correct in that this is going to be a managed event. It's going to be a more controlled buying as the price goes up, rather than computers just coming in and just buying everything, and this thing just does whatever it would do in that case. I mean, nobody knows what would happen in that case. And by no means am I saying that I'm not saying that I don't think the price can go up a lot, because I do. I'm just sharing a theory that seems to make a lot of sense to me. As far as what the SEC is doing and how price is climbing higher, I think this theory makes a lot of sense. But let me know what you think in the comments about that. I think I've covered everything there, so I think we can move on to technical analysis. So, as you can see, we have broken out of the falling wedge here, right? And what you'll notice is that price has come right up. We're looking over here at the volume profile now. You can see how you have this high volume node here. And once price gets to the other side of that, volume drops off. So this is an area of lack of price acceptance, which explains why we're seeing some resistance here. Now, as price comes back down, you'll note that we have another low volume node. So as this between 1736 and call it $20, there is more price acceptance. So I would suspect that we trade within here. Doesn't mean we have to. We could just, market open and we continue climbing higher. But resistance and support. So now we can pull up the computer algorithm and see where it would line up in relation to that low volume node. So the 50% retracement is actually below the low volume node. So we might not even get back to the 50% retracement yet, which would be around 1650. So what is really important here, in my eyes, is that we've broken out of the falling wedge to the upside. We're climbing higher. We have put in a high, higher low, and now we put in a higher high. So that's the first. Now, it is you barely put in a higher high. Technically, it does count. But this is the start of a trend change. If you come over here if okay, for example, you put in a low, right? You put in a lower high, lower low, lower high. That's a trend working lower. So how do you know when that trend is changing? Well, one of these swings, right? One of these lower highs would have to be broken, which we did here, right? So here's your previous lower high, put in a lower low. Now we've broken that prior swing, put in a higher low, and now we put in a higher high. So the trend is starting to change. It looks very good. A very strong case that we've put in the bottom, and we are going to continue climbing higher from here. So with all of that said, we're just going to have to keep an eye on it, see what it does. Trying to find. So prior, the computer algorithms had sold here at the 50, right? They hit their target down here at the negative 236. So if we pull the next series, meaning from where the computer algorithms previously sold down to the new low, the next point where this large computer algorithm would be looking to sell would be the 50% retracement around 3286. They'll continue to sell all the way down to the or up to the golden zone. So this area here looks like an area of high price acceptance to me. You can see there's a lot of volume that had been traded within this price range. So there isn't really a point where I can be like, okay, we have a low volume node here lining up with the 50% retracement, so that could pose some serious resistance for us. I just don't see that, so that's good. The only point that I would see heavy resistance would be as we get up closer to the golden zone, but even then, you still have quite a bit of volume being traded, and at that point, we're going to be above the 200 EMA on the 4-hour chart, and this chart would be looking a whole lot more bullish, in my opinion. So just some things to think about. I think that's pretty much everything I have to update. I don't want to keep rambling on. So until next time, I'll talk to y'all soon.